Hey, Ralph, put on your investment banking hat again. We had a bunch of IPOs that I feel like you could argue didn't go very well. Like they IPO'd, which was something, but they're trading below the IPO price, whether you're looking at ARM or Instacart, et cetera, or Birkenstock. M&A started to heat up. It looks like the pipeline was getting a little better. We got that big deal yesterday with Exxon and Pioneer. Do you think the investment banking world is going to be happy next year or not? Like, is this window going to stay open, you think?
If you look back 40-some years to 1980, and you look at M&A activity and equity capital markets activity, they are secular growth businesses. They tend to correlate to the GDP and the aggregate equity values. So they go up over the long term, but they're cyclical businesses, generally characterized by 3 to 7 year up cycles and 2 to 3 year down cycles. We're sort of at the end of that second year of a down cycle. We're certainly seeing at Evercore a lot of green shoots. They're not quite out of the ground yet. I believe that the equity capital markets will come back earlier than M&A will, just because M&A to get closed tends to be a longer cycle business. But I would honestly expect activity to pick up in the early part of next year, and I would expect 24 to be a better year than 23 and 25 to be a better year than 24.
If we're out of that 40-year bull market and yields are no longer going to continue to go lower and lower and lower, what is the order of magnitude in terms of the change we're going to see?
Well, I honestly don't think we're going to have a massive decline in equities because I think the economy is okay.
Right.
I think what we will have is a pretty long period of sideways movement while earnings catch up with the new discount rate.
But in a
so
world
we'll grow our way into it.
Yeah, but in a world where you've got higher nominal inflation, you're effectively, if you've got that
and you're
inflation,
falling behind.
Then you're falling behind.
Yes, you are.
So, what do you do with that? How do you make money in that environment?
Do you make money in that environment?
Yeah.
It's hard.
Because it feels like the 60-40 is going to be toast.
I think if you're sitting in let's just say you're the chief investment officer or the head of a pension plan, and your actuarial assumptions were 7% or 8%. The good news is bond rates are higher, so you're getting more help in that part of your portfolio. But to assume that equities are going to go up 7-8% and private equity is going to go up at a huge premium to that, which it has historically, and I believe will continue to be a premium to the public markets, it's a little more nerve-wracking when you're flying in the face not of bond yields declining from 15% to 1.5%, but going from 1.5% to 4.5% or 5% or even 4%.